Global supply glut is expected to keep oil prices low through 2026. That's according to Deloitte Canada's energy forecast released this week. It expects a benchmark barrel of West Texas Intermediate to average $58 US a barrel, which is down $7 compared to last year. If that forecast holds, it will certainly impact Alberta's budget, which assumes benchmark prices just under $62 a barrel. Andrew Botterill is the Energy Resources and Industrials partner at Deloitte Canada. So what's causing the glut we're seeing right now?
Well, we've seen a lot of production growth out of ourselves, Canada, US, Brazil, Guyana. There's been several countries that have grown a lot of production over 2025, which has resulted in us being in a situation here where we're oversupplied.
Yeah, can you say some more about Canada's place in the supply and the oversupply over the last year or so?
Well, I think as Canadian producers have looked to become more efficient, create get rid of some bottlenecks and focus on operations, they're becoming exceptionally efficient and delivering a lot of volumes into the U.S. And then on top of that, with the expansion of our pipeline to the West Coast, that also means that more volumes are heading west and leaving the country too. So it's been a ripe environment for investment in our oil projects in the last few years, and that's kind of added to the oversupply that we're seeing around the globe.
So, okay, walk us through the other drivers and factors you see shaping the year ahead for oil.
Yeah, absolutely. So I think when we look to oil, like we talked about, we're in an oversupply position and have been for the better part of the last 9 months. It's going to be interesting to see, will OPEC decide that they want to put more volumes into the market and maybe create more downward pressure? I hope not. But right now we're expecting, like you said, $58. And behind that is an oversupply, but the recognition that economies are starting to really strengthen, we think. So 2025, I say, was good, not great for a lot of economies around the globe. And we talked about recession, but with lowering interest rates around the globe in a lot of different developing and developed nations, I think we're expecting to see more robust economies in 2026. And that'll start to maybe drive some of that consumption and close the gap to oversupply.
Some strengthening on the demand side. One question about OPEC, like what's the calculus at OPEC on whether to increase supply or to draw back?
Well, they came out this weekend and mentioned that because of the geopolitical uncertainty, we talked Venezuela and others around the globe, that they weren't going to release the extra volumes that they'd actually planned to put into the market here at the start of the year. So they're recognizing that there's some geopolitical instability right now, so they're not looking to make it worse. I think they're always looking to kind of balance their own budgets as well. So, I think they would like to see prices that are closer to 60 than 50. And as such, I think we might see them hold back volumes this year and try to at least strengthen and help the globe, I think, get through that oversupply.
I suspect you'd sent your report off to the printers before things changed as much as they did in Venezuela. Now, there had been signals, but how does the situation in Venezuela play into your forecasting and how you see 2026?
For 2026, I don't think fundamentally there's going to be too much of a change in the supply demand. If we see the embargo lifted on Venezuela in the next coming months, depending on how this transition goes, that might be a little bit more volumes that come into the market. So there is, potentially some downward pressure from that. But really, when people look to the Venezuela that's going on right now, it's really about what does 5 and 10 years out look like. Is Venezuela going to attract more investment, develop more heavy oil, and compete in the market? And so it just means I think that Canadian producers are going to be focused on making sure that they're top of mind and really resilient and efficient in their investments, and recognize that they might have to compete in the next decade with maybe more volumes from Venezuela.
Right. Venezuela currently at just under a million barrels a day, and not much of that entering the conventional market. And you expect that could change on a 5 and 10 year horizon.
Absolutely, it could.
Yeah. So, okay, bringing it home, what does this mean for the investment climate here in Canada? I mean, you talked about efficiency, but at a time when the province and the federal government, to a degree, are looking for the private sector to build a pipeline to the West Coast.
Mm-hmm. Right, absolutely. So I think this just adds one more thing that needs to be solved, right? We have to recognize that these projects are a mix of supply and demand. Canada has a lot of supply. We have the volumes that we could grow. Pipeline is an example of a project that we could do and grow production, but ultimately we would need to compete. So getting that supply and demand picture, that's what the focus is going to be, I think, for 2026 is, does Canada want to grow production? Do we have maybe enough capacity and ability to put volumes into Asia? And if so, would that be the backstop of a project to the West Coast? And again, much like Venezuela, our projects are going to take years to get done, and just recognizing that the dynamics might shift a little on the heavy oil side around the globe. Getting that demand picture figured out in that 5 and 10 year horizon is what's going to backstop an investment like that for growth for Canadian oil.
What's the relationship between Venezuela's reserves and the potential there and the Asian market?
Well, I think for conventionally, most of those volumes have been traded into, when we look back historically, into the U.S., and we're part of the competition that we would have seen into the U.S. market, and as well some globally. I think that we haven't necessarily looked at in depth as what they look like going into Asia. I think right now there's just a lot of questions on what Venezuela does develop and what does that look like going forward. But I don't know. I think we would look to Canadian volumes and expect that, given where we are and the ability to invest in our assets, and they're known and well understood and de-risked, I think there's a lot of propensity to think that our volumes could be more preferential into the Asian market.
We're tight for time, but I wanted to give you a second to say something about the forecast. You've given certainly a rosier picture for natural gas. What's the story there?
Well, it's just a far more structurally sound natural gas market this year than it was last. When we look to last year, we were getting ready for LNG Canada. That has now come on stream and is increasing a lot of the volumes that are going out off the West Coast now, and that's going to be increasing more here in the first couple quarters of this year. So what we have now is a far more structurally sound natural gas market. So I think our Canadian natural gas producers are going to see the benefit of those investments and the benefits of that growth and the drilling that they've done in the past few years. And we're going to see, we're forecasting $2.95 per MCF for AECO natural gas price this year, which is far better than what we saw last year, and I think is an indication of how more structurally sound the natural gas market should be this year for Canada.